which screen are you showing right now? Are you showing the
I'm seeing your PowerPoint presentation, but your screen, not the presenter view.
All right, hold on a sec. I'm having technical difficulties with my screen here. Huh. Oh, there it goes. How about now?
I still see the PowerPoint.
Hmm. I'm going to pause it here. Sorry, everybody. Just give me a second. I'm having some issues here.
Okay, so while Eric goes over our little technical difficulties, I'm just going to go over a little bit of housekeeping. All your phones are on mute so that we can reduce any background noise. But if you do have any questions during the session, please feel free to put them into the GoToMeeting interface, and we'll be sure to address them at the end.
Great. How about now? Now can you see it okay?
I don't see the full view.
Good grief. Which screen do you see?
I'm seeing the presenter view with the notes on the side.
Oh boy, it's not what I want to show.
Okay, now I can see. Looks great. Okay. So for the next 30 minutes or so, we'll be going over a bit about who TGO is, for those of you who don't know us, and Avalara. And then we're going to go into the presentation with a quick Q&A at the end. So next slide.
I don't have the one that you're thinking of.
Okay, so a little bit about TGO. For the past 27 years, TGO Consulting has specialized in ERP, business intelligence, business process management, and corporate performance management. In the ERP space, we've actually been a GP partner since 1994. And we're always looking for ways to help out our clients enhance their systems and improve their bottom line with solutions like Avalara. So without further ado, I'd like to hand it over to Eric.
Thanks, Kathleen. Sorry about the technical difficulties. So thanks, everybody. I'm going to be pretty quick about this because I know that time is of the essence with everybody, and sales tax can kind of sometimes get people to tune out. It's not the most exciting topic, but unfortunately, it's a necessary evil. So like Kathleen said, I'm the Microsoft Channel Manager as well as the Stage Channel Manager for Canada. I'm U.S. based, but I do have Canadian roots, so hopefully that gives me some brownie points. The topics I'll be going over today will mostly be around the U.S. sales tax compliance, because that's where most of the complications lie. The Canadian system, as you all know, is very simple. If you have any questions at the end, feel free to type them in the chat, and we'll try to get them addressed for you. If there's something I can't answer, we'll definitely get back to you. So what I'll kind of rip through today, 4 different topics, a little bit overview of sales and use tax. Just so you know, on a side note, I'll kind of go very quickly through the use tax because it probably doesn't have a whole lot of implications with Canada unless you have some very specific registrations in certain states. I'll go through some commonly overlooked obligations that a lot of companies tend to skip over. A couple of things how to reduce your risk of audits, and then finally questions, and I'll show you some contacts. That said, we'll just jump into the overview. So basics, sales tax versus use tax. Sales tax, of course, is imposed on the gross receipts from the retail sale of tangible personal property. Use tax is kind of the ugly stepchild of sales tax. Use tax is imposed on the consumption or the use of tangible personal property in a state. So case in point, a perfect example, if you owned a coffee shop and you allowed employees to consume the coffee on premise, but you used the paper cups, the same paper cups that you sell to customers, that is subject to use tax. Typically, use tax is imposed on transactions or purchases originating outside of state. But again, since most of your businesses are in Canada there, you would have to really have a physical presence in a state to calculate the use tax. So again, I'll kind of not go into too much detail there. So the simple compliance tasks for sales tax, that is, revolve around calculations, reporting, the returns, and the remittance. Within these, you have your Nexus rules, you have exemption rules, you have to find the correct set of rates and then validate the address, which is very important. As you see at the next check mark, validating the address is very important because sales tax jurisdictions do not follow standard zip code lines, another part of our very complex system down here. You also have certain taxability rules on products, which can be very confusing, and then jurisdictional sourcing rules. And this slide is very important as well. You know, most companies don't really realize how many obligations they have. It's very important to know how much business you're conducting in certain territories, which goes back to the Nexus triggers. Do you have multiple locations in very complex jurisdictions? And this could include states like Alabama, states like Arizona, where they have, or even Louisiana, where they have multiple parishes or multiple counties that you have to remit to. Do you have multiple tax returns? Do you have multiple systems? Do you have independent agents, or are you selling digital goods? And these are different taxability. It's really important to know, especially if you're a Canadian-based company, how much business you're doing in the United States and if you're making possible Nexus triggering events. So here's some of the commonly overlooked obligations that a lot of companies miss. This is a funny slide. You know, we do a lot of studies with Wakefield, and a couple years ago they found that nearly half of accounting professionals think that being audited is more stressful than a divorce. So try to avoid it at all costs, both of them. So one of the big overlooked obligations is exemption certificates. So even if you don't sell direct to consumers, you may still be part of the transaction through a supply chain. It's really your job to reassure the state or the states that you're doing business in that you are exempt from collecting that sales tax. Not-for-profit organizations and governments also need to prove exempt status. This proof is typically in the form of your traditional exemption certificate, which can vary by type and vary by requirements. Some certificates are limited to purchases of only certain items, and others are limited to certain items used for the completion of a certain project. Even some certificates provide a fractional or even a percentage exemption, and others are date sensitive, such as the state of Florida, where exemption certificates expire every year. Depending on your business, you may be responsible for both issuing and collecting certificates, both processes. The proper application of each exemption to each sale is crucial. Without that proper documentation, auditors, they could determine that you understated or that you improperly exempted taxable sales, and that could cost you. When auditors come in, they will ask to see each exemption certificate that's attached to the invoice in question. So exemption certificates have three main components. They're the collection, the validation, and the storage. This starts by a sales or an invoice origination and certificate request, but even after this process, the cycle never stops. The process begins with the customer and the ERP software, because this is where sales and invoices originate. When your customers are exempt from sales tax by statute, the seller needs to collect an exemption certificate from them. But oftentimes customers do not know what documentation to provide, and those taking the order sometimes do not have the certificate expertise to know which documentation they really need. Additionally, the certificate collection process itself can be really time-consuming, and because of the lack of knowledge on both sides or due to a lack of processes on the seller side. So it's really especially confusing at times. Effective certificate management means that each piece of the exemption certificate lifecycle works together to ensure your business minimizes audit risks and also maximizes staff productivity and improves the customer purchase experience. You want it to be very quick and very simple. So bumping back to use tax, which 46 out of the 50 sales tax collecting states also charge use tax. To put it very simple, consumer use tax is a sales tax that is collected and remitted by the buyer rather than the seller. Use taxes are really meant to minimize unfair competition between sales made in and out of a state. But knowing when they are owed can be really tricky. And because payment is often on a self-reporting basis, again, a self-reporting basis, most businesses and consumers overlook this obligation. And a side note to that, most auditors are really looking at use tax these days because they know it's something that, like I said, is overlooked all the time. How does it work? If your business purchases, I'm going to put this in very simple terms, if your business purchases goods from another company within the same state, sales tax is owed, which the seller collects and sends to the appropriate taxing jurisdiction. If your company buys goods outside your state or online, you don't pay sales tax, but you are required to pay consumer use tax for the storage, the use, or consumption of that tangible personal property. Case in point, when I talked about the coffee cups. Again, this is a little bit tricky. If you're a Canadian company, you probably don't have to worry about it. But companies are responsible for self-assessing when and if use tax is accrued. So it's so important because if any errors are made in computing use tax, they must be reported to the appropriate jurisdiction on your balance sheet as an open liability. You then must remit the correct amount with your next tax return. The burden is on you to prove that the sales tax has been reported and paid. You don't want any penalties and fines. Online sales, this is a big one nowadays because of the Amazon, what we call the Amazon laws that are still stuck in the U.S. legislature, which will probably still happen for a while ago. Many companies might think they don't owe any sales tax if they sell online. Unfortunately, that's really not the case. It is going to continue to expand. In the U.S. alone, there are more than 11,000 taxing jurisdictions. And in a lot of states like Florida, Texas, California, they're requiring out-of-state e-commerce companies to collect sales tax for the first time. If the national effort to effectively end tax-free online shopping succeeds, the already difficult task and risk-prone process will only worsen with collection of sales tax. The way you deliver your goods sold online in online transactions will have a huge impact on your tax obligation. Many online sellers, case in point like Amazon, use drop shippers to deliver goods, which creates a complex tax obligation in itself. If you use any third party, whether it to be a drop shipper or a supply chain or even an online affiliate, this can trigger Nexus for your business. And the big one now is to pay attention to if any of your businesses are using fulfillment by Amazon, especially in the United States. This is a Nexus potential and very strong Nexus triggering activity because your product is being shipped all around the country to be closest to the end destination. So wherever your product ends up in one of Amazon's fulfillment centers, that's a big Nexus triggering event. And that means you're going to have to register and remit for that state. So again, if any of you are using fulfillment by Amazon, make sure that you're keeping up to date on their website to find out where your inventory sits, because the auditors are looking, the state auditors are paying attention to this. Like I said inside, the definition of Nexus is really changing rapidly every day. So a lot of e-tailers, I really don't like that word, but we'll use it. E-commerce companies, what they tell us, calculating sales taxes accurately is crucial and critical. They want the calculations to come back to them, to their site in sub-second time. Managing sales taxes, and especially the rules around them, is a painful, risky, and just an error-prone process. The embedded reporting capability is really necessary to have the whole process very streamlined, and reducing the risks of audit is obviously critical with any business. You don't want to do that. You don't want that to be part of that 44% and think it's more stressful than a divorce. And a lot of times outsourcing sales tax compliance is strategic. Just like a lot of companies outsource payroll, it's just a burdensome task full of risk that companies just don't want to deal with anymore. So I'm going to jump now into sourcing rules and taxability around those. This is another complicated part of this U.S. system. Sourcing rules govern which states dictate the taxability of a particular sale. Sales made within a single state, otherwise known as intrastate, follow the taxing rules for the seller's location or their ship from address. This type of process is called the origin sourcing. On the other side, sales between states or interstate sales typically follow the taxability on the customer's ship to address. This is a destination sourcing. As you see in the slide here, a few states have origin-based selling rules, and some have mixed sourcing rules, which is even more complicated. And then all the rest is destination. In the destination sourcing, Nexus rules really come into play. If you do business in multiple states or operate as part of a supply chain, this can get very complex very quickly, especially if you use drop shippers located in other states, like I said with the Amazon. Understanding how and when to charge sales tax to consumers and when to issue exemption certificates to distributors becomes complicated and creates added risk. So taxability laws are constantly changing. There are approximately, from what our sources say, about 2,000 to 3,000 taxability changes in the United States per month. So it's always recommended to review the taxability on your products and your services, especially if you've added new products or services recently. Without having sales or use tax experts interpreting laws for each and every taxable state and locality, as well as a sophisticated tax decision-making system, it's really difficult to ensure that all taxable transactions are properly taxed. It's essential for a seller to know what is taxable in each application, in each applicable taxing jurisdiction to prevent tax exposures and future liability under audit. Companies need to have knowledge of what is not taxable in order to avoid overcharging sales tax and becoming a victim of a potential class action lawsuit, which has happened on more than one occasion in the United States. The more a company can automate the tax decision-making system with respect to both sales and purchases, the more they can minimize or even eliminate their tax exposure. We have on here a great example of different product taxability. This is a fun one. So the Milky Way Original, which is on the left, is non-taxable in a lot of states because it contains flour, which means it's a food product. But the Milky Way Midnight on the right is taxable because it does not contain flour, so therefore it's more of a candy. So this is just one key example of the wackiness of some of the systems. So there's, like I said, there's different rules between states. A lot of industries have different taxing rules or variable taxing rules. Some of the big ones are software and hardware, especially now with downloadable or streaming software. Medical devices have a lot of different taxabilities. Clothing and apparel is a big one. New York is a great example. If clothing is under $100, it's generally non-taxable. If it's over $100, it's taxable. Dietary supplements, that's changing constantly. That's a big target as well. So another part is paying the price of not being compliant. Many businesses today still calculate and resolve tax compliance manually, despite the process being really inefficient, very time-consuming. Cumbersome is a word that comes to mind, and of course it's very prone to error. Failing to comply can put your business at risk for an audit, which you always, of course, want to avoid, which can be very, very costly. The average cost of an audit, depending on the research group that you're working with, there's two that we work with, Aberdeen and Wakefield. Aberdeen puts it anywhere, an average cost of at least $100,000. Wakefield puts it between anywhere $34,000 to $60,000. Of course, it depends the size of your company. But it's obviously, no matter what, when you factor in the time and the stress, it's going to be a very costly endeavor. There's a few industries listed on here that tend to draw the attention of auditors more than others. Manufacturing and construction and retail are a few of them, and a lot of that is dependent on your exemption certificates, as we mentioned before. To compensate and try to minimize audit risk, some companies over-assess tax liability, and others prepare, quote-unquote, prepare by setting aside money in case they are penalized for non-compliance. Companies that under-assess sales tax face kind of a more serious risk of penalties and interest due to outstanding tax payments. You could even face fraud charges if you do it this way. Especially if it's proven that you willingly withheld tax but didn't remit to the state. That's a felony. So a few things to rip through to reduce your risk of audit, the A word, as I call it. Ensure that your process for keeping sales records will help and not hurt in case you get audited. Sales tax audits tend to strike terror into the hearts of people. They call it the boogeyman. Our current economic climate really has increased your chances of being audited. I'm not trying to scare people, but it's true. With so many states trying to balance their budgets, they are increasing their efforts to find unpaid taxes through audits. Audits can significantly drain business time and, of course, your resources. If you take the time now to review your processes for keeping sales records, it really will go a long way towards minimizing your costs in the event of an audit. I'll just put a side note on this as far as the auditors looking at you. The state of New York has, last count, about 1,900 auditors. And I think probably a majority of those auditors spend their time looking at companies outside their own state borders, including Canada. So back to your process. When you're reviewing your sales records, look for the following things. Make sure that your information is clear and complete. This includes your ledgers. You know, the state auditors might want to take a look at, including accounts payables, accounts receivables, your general ledgers, your federal income tax returns, and any other books or records underneath those, which includes, you know, purchase orders, paid bills, invoices, contracts, and of course exemption certificates. Next, make sure your information is easily accessible. If you have any of the information that I listed before easily obtainable, it'll require less time from the auditor, and I know they usually appreciate that very much. And then lastly, be able to really effectively show the flow of each transaction. Auditors really must be able to follow the trail of each transaction that you've made and match it up with all the documents pertaining to each transaction, i.e. your exempt certificates. Watch out specifically for items like chargebacks or returns that you may not have adequately documented. Just like in your dating life, first impressions really matter. If the auditor sees that you can effectively show what they will ask you for, it will save money from penalties that you might have otherwise incurred for incomplete or even incorrect documentation. If your process doesn't really support these points, then really take steps to ensure that it does before you get that audit notification. So there's some things you should do to reduce audit risk, and I'm going to hit on the first one kind of more specifically as Canadian companies. If you're doing a lot of business in the United States, we really recommend that you do a Nexus study. You hire somebody, a CPA firm, or, you know, in this case, Avalara's professional services, to look into your business holdings and see if the business that you're conducting in the United States or the states in question are going to trigger Nexus and your requirement to remit taxes in that particular state. Stay up to date with the rates and the rules, and automate. And then also, of course, make sure you have an understanding of your filing requirements. Make sure that your calculations are using not just zip codes, because as I mentioned before, that's not really truly accurate. Of course, detailed sales records and a really good process for managing exempt certificates. Not like most companies where they just collect them and they put them in a file folder and shove them in a file cabinet where you never know if they're valid or if they're expired or if that company's actually been acquired or changed hands, because those manila file folders do not talk to you. It's a one-way conversation. And then, of course, we have you know, Avalara's suite of products, our tax exemption or our tax processes. There's a benefit behind it with using a software is we never sleep, we never take a vacation. There's never a sick leave, or I should put in here jury duty, which I'm going to have next week. We're totally accurate, and you know, it really allows you to focus on growing your business and doing activities that generate revenue, not just calculating sales tax. So I'm going to take a moment to just kind of overview how our system works. So instead of researching rates, building your tax tables or your tax schedules, and implementing a tax process, you install a software connector, i.e. AvaTax, to your ERP system. Because we're cloud-based, we're always keeping up to date with the tax rates, the tax rules, and the boundaries all the time, every day. When you enter an invoice or take an order online, your system communicates with our web service and sends a little encrypted the XML file with your transactional data. We calculate the tax and return it back automatically to your ERP. This happens really, really fast, about 0.4 of a second for a round-trip calculation. See if I can keep up with the slides here. So at the end of the month, you no longer need to run reports or fill out forms and then cut checks and mail them, or sometimes online, to each of the taxing authorities. When you've processed all of your invoices, you can log into your admin console and do a quick reconciliation of and then we will file and remit your taxes automatically for you on your behalf. And then what happens is you just pay us one amount, and then we take care of the rest. It's an end-to-end solution. I use that term a lot, but it's true. We do this by using automation, and the idea is to save time and money and mitigate the risks associated with managing sales taxes internally. So there's three main components behind this. There's AvaTax, so we're doing precise rate determinations, the sourcing, the address validation, which we do on a rooftop level by using latitude, longitude coordinates as well as with the full zip code. We determine the product taxabilities. Back to the candy bar thing, we're constantly tracking all those little bits and pieces, and of course we have the reporting, and then we will on the side do the consumer use and then global sales tax calculations, which includes Canada and about 179 other countries. There's a second part, cert capture, which we talked about. This is our exemption certificate management application. So in the automated exemption certificate lifecycle, customer data is passed along to cert capture, where certificate requests are generated to customers. Cert capture will track the status of requests and help ensure customers provide only valid certificates for their transactions. I can also retrieve and provide copies of certificates to auditors. In addition, cert capture serves as what we call the source of truth. I'm using air quotes around source of truth for exemption certificates, and will manage those certificates, including tracking expirations and certificates that have been deemed possibly invalid by the tax departments. The management of certificate data is really critical in the role of tax decision process software. Certificate data is passed to the tax decision software where sales tax decisions are made for invoicing. Really at this step, the ERP software also interacts with the tax decision software because it needs to know what tax amount, really if any, it needs to apply to the invoices. If the tax decision software has accurate certificate data, then customers who are exempt from sales tax will be billed correctly. If not, then exempt customers will be billed incorrectly, and the seller's audit exposure and the risks increase. And then the last part is the returns. This is what we do to take care of all the monthly, quarterly, or annual returns on customers' behalf. This includes, you get notice management, so if any state or jurisdiction sends you an audit notice, this will be included in there. Retention compliance, this helps reduce your penalty and interest exposure. And then, what really customers love is having a single source of payment and processing the returns on their behalf. And then there's a few professional services that we have listed here. One is not shown, which is the Nexus Study, which I generally start with a lot of my Canadian companies just to get an idea of any potential liabilities they might have. We have some customized training for AvaTax and your connection to your particular ERP, and some best practice for your certificate management and their sales of use tax. Most of our professional services team are made up of former state tax auditors and licensed CPAs, so they really know their stuff. So that's about it. I thought I would get through this pretty quick, and if there's any questions, I'm open to it.
Thank you, Eric.
Kathleen, you want to?
Yeah, thank you. I think that gives us a lot to think about in terms of taxes. If you have any questions, you can reach out to Eric and his contact information's on the screen, or you can feel free to reach out to us at TGO Consulting. Our email is info@tgo.ca, and you will be receiving a follow-up email with this with our contact info if you happen to have any questions, or if you're interested in learning more about Avalara. So currently we do not have any questions, but we will stay on here for probably another 5-10 minutes or so. So if you do have any questions, please feel free to put them into the GoToMeeting interface and we will answer them.
Yeah, I can honestly say, Kathleen, sometimes when you start talking about sales taxes, people can sometimes nod off. It's a common occurrence. I wouldn't be offended at all. Or they get really scared and run away.
Or that.
Especially when you talk about the U.S. stuff. Well, I made an assumption that most of the attendees would be based in Canada. That's why I kind of tried to hone in on the compliance part for the U.S. because your system up there is so incredibly simple.
Mm-hmm.
And so a lot of my newer customers don't really realize how painful it is down here. So you know, I tell a lot of my colleagues who get leads just for Canadian companies to not even put too much attention into it because it's probably not going to be needed.
Okay, well, it doesn't seem like we have any questions for today. Again, if you think of them afterwards, please feel free to email us. Again, you can contact TGO as well. Our follow-up email will be going out shortly after this webinar. So I just want to thank everybody for coming out this afternoon and listening to Eric talk about taxes. So have a good afternoon, everybody, and thank you, Eric, for presenting today. And we'll be following up
Thank you too.
with everybody shortly. Have a great day, everybody.
Thanks, everybody.